The webinar will focus on blue carbon financing. The webinar is co-convened by EU project Invest4Nature, Network Nature Plus, Sea Blues, and the Norwegian Research Council project MAREA. The goal of the webinar is to bridge the gap between blue carbon project developers and private investors seeking impact investment, fostering meaningful connections between the two groups. I'm Chen, Senior Economist at Norwegian Institute for Water Research, expert on economic valuation of ecosystem services and coastal investments. Today, I have the privilege to introduce everyone first. The Norwegian Living Lab, the Blue Forest in Norway. Norway has a long coastline and its blue forests are under different conditions. In northern Norway, we have extensive urchin barrens, as you see, the coastal line marked by red lines, where sea urchins have grazed away much of the kelp forest. And in the southern Norway, in the Oslo Fjord, where you see the yellow lines, where kelp forest and seagrasses has been declining due to the eutrophication and overgrowth of turf algae. In both cases, blue forest ecosystems have deteriorated, and restoration would enhance carbon storage and sequestration, as well as biodiversity and co-benefits. Within our Living Lab, we are assessing the economic value of blue forest ecosystem services, estimating the resilience value generated through the blue carbon restoration, and developing a roadmap proposal for financing blue carbon restoration efforts. However, we also recognize that most current financing still comes from public grants. If we aim to scale up blue carbon forest restoration activities, we need our experts to guide us on how to successfully secure private investments. Today, we are pleased to welcome you two guests. The first guest is Brian Takeda, founder of Urchinomics, co-founder of Restorae, head of restoration of Kelp Forest Foundation, and members of Secretary of International Affairs in Japanese Blue Economy Association. Brian today will share with us his insights on what type of financing support blue carbon projects are looking for. Here's your floor, Brian.
Thank you very much, Wenting, and thank you very much for this opportunity to talk a little bit about blue financing and how Restorae is approaching this. Before we get into it, I just wanted to set the stage for what Restorae works on and what our values are and what we stand for. The challenge that we see is essentially the fact that we have applied the genius of human imagination and ingenuity and applied it at industrial scale to extract as much resources from the land and the oceans for the last 250 years. And we need to change our approach to capitalism because we've effectively pushed our natural capital to the edge of bankruptcy. So in order for us to reverse that, we need to evolve from an extractive economy to a restorative and a regenerative economy. And that's very much what Restorae is focusing on. So what we do is effectively to Aikido, or to take the momentum of existing business models and transition them from an extractive approach to a restorative approach. And the idea being that we want to make restorative ventures investable, profitable, and scalable. Now, how do we do that? We do that through two initiatives. One is to invest and develop restorative technologies that can geometrically scale restoration effects. And the others is to support restorative business models. So those economic models that improve ecosystems while generating profits. So today I'm here to talk about nature-based solutions, particularly blue nature-based solutions that can contribute to restoration, that can be funded from various funding sources, which we'll go into afterwards. So of course, our core that Restorae is focusing on is very much restorative subsea technologies. We are also collaborating with companies like with Distant Imagery, where we're also applying restorative aerial technologies. We collaborate also with NIVA and NIVA when it comes to restorative aquaculture technologies, where we responsibly breed predatory species so that we can put them back into nature. We are also developing MRV technologies, so essentially autonomous drone technologies using biomimicry to improve the ability to monitor marine ecosystems. Also collaborating with companies like Blue Carbon to generate artificial upwelling and leveraging tidal energies, biotechnologies with C6, and of course material technologies with Algascope. The reason why I'm bringing up all these examples are half of these ventures are already profitable and are investable. Others are still trying to get their business models correct. But the point is that there are ways to generate profits and restore marine ecosystems at the same time. Now, today's theme is very much about financing. And so I'd like to go into some of the alternative financing solutions that we have seen in our space. And I'll allow Ross, who will be joining us afterwards, to talk about the direct investment side. But the alternative funding schemes that we are seeing that have a lot of potential are effectively in the space of carbon dioxide removal, nitrogen removal, biodiversity improvements, as well as social benefits. Now, these are some of the ecosystem services that we see whenever we restore blue ecosystems. So the question is, okay, how does that actually work in practice? Well, at the end of the day, my answer is going to be quite boring, but it is ultimately come down to regulations. So regulations are typically what is driving the development of voluntary as well as compliance credits that are the backbone of biodiversity, carbon sequestration, or some of the other ecosystem services that are converted into money effectively. And what is at the backbone to that? Of course, it is the Paris Agreement when it comes to climate. It's the Kunming-Montreal Biodiversity Global Framework when it comes to biodiversity improvements. But I think what is probably more relevant to our audience today is actually some of the developing laws that we're seeing in Europe as well as in Japan that I think gives us a lot of hope and a lot of potential. The first is the EU Restoration Law, as well as the EU Commission's efforts to drive nature credits. Other developments that we're seeing in the United Kingdom, which we think are very exciting, is of course the biodiversity net gain laws, as well as the nitrogen credits coming from Nature England. But if we look at Norway specifically, we also have domestic initiatives that are already taking form. So in 2024, we had the Vedtak 789, which requires the sitting government to establish a holistic restoration plan for wild kelp forests in Norway. But we also see, even at the local municipal level, there is arealneutralitet, or neutrality of area in terms of nature and development in the Plan- og bygningsloven. So what I'm trying to highlight here is that there are international, regional, as well as national and local regulations that are pushing various new funding mechanisms that are starting to materialize in various regions of the world. And I think that these initiatives will be the true funders of restoration. So if we take the EU approach for a moment, I'm just going to highlight, for the interest of time, just looking at a couple of the key points. One is, of course, the nature credits that were announced earlier, and the idea of trying to monetize the ecosystem services that come from restoration beyond carbon. We also have seen that the EU has unveiled the Ocean Pact, where over €1 billion have been committed to coordinate between ocean states to allow restoration plans to move ahead. What I think is most exciting about the restoration law is the targets. So in very simple terms, the EU restoration law expects to have 20% of degraded ecosystems to be improving by 2030 and 100% of degraded ecosystems to be in an improving state by 2050. Now, what's key here is that typically regulations have focused almost exclusively on terrestrial ecosystems, but this law very specifically highlights oceans and includes blue ecosystems that historically have not been addressed via the IPCC. So I think the idea that the super state of Europe is moving towards this and dragging 27 member states in that direction is very exciting, because one thing that's really cool about the EU system is that it's really hard to pass laws, but when those laws are passed, it's really hard to change them again. And this is already in place, and the EU restoration law is going to come into effect in summer of 2026. If we were to take another approach on the other side of the planet and we look into Japan, Japan has established the J-Blue credit mechanism. So the J-Blue credit mechanism is essentially a state-backed nature credit plus carbon credit which includes seagrasses, kelp forests, mangroves, tidal flats. But essentially, it is a mechanism that allows entities that are restoring ecosystems to be compensated for the ecosystem services that are generated. The J-Blue credits are by definition technically a carbon credit, but the carbon credit acts almost like a plate at a buffet, which you can then add other ecosystem services values on top of it and stack carbon sequestration, biodiversity, community benefits, whatever that can be validated using the best science we have today. The J-Blue credits allow that to be converted into transactionable money. So we're talking about credits that actually generate cash, which can then turn into cash flow, which then can be funded through debt or could be funded through equity or any other vehicles that are available. The J-Blue credits are unique, again, because it allows the stackability of other ecosystem services. The credits are selling at well over $400 a ton, which is between 10 to 15 times higher than other carbon credits out in the world. But I think what's really underpinning that is that that credit mechanism is also aligned with national policy. So in 2024, Japan included seaweeds in their NDCs, reporting into the Paris Agreement. Japan also has quantitative targets of how much CO2 removal is going to happen through blue ecosystems. So these are things where the state policy and the market mechanisms are coming together to allow restoration to not only happen, but also be funded. So to kind of close up my point here, we believe that beyond the direct investments from organizations like Katapult Ocean and others that are diving directly into equity investments, ecosystem service credits of various types, we expect to be the major drivers of funding, where restoration has historically been an expense line item on an income statement. But through these credit mechanisms, they become investable assets that end up on the balance sheet. So with that, I think I'll say thank you, and we'll connect again afterwards.
Thank you so much, Brian, for very good discussion or insights on what kind of funding actually you could looking for normal SMEs. Both regulation and market mechanism actually function together. Now I introduce our second speaker. That's Rose Brook. So sorry, I just need to read a little some notes. Yes, Rose serves as a general partner at Katapult Ocean and co-leads the firm's investment team. Rose will actually provide a little bit insights on what the private sector roles in supporting the blue carbon projects financing.
Thank you, Wenting, and thank you, NIVA, for having me. So Brian touched upon regulation and structural failures in the financing sector. I think I want to paint a bit of a high-level picture on how that affects mobilizing capital for investment in nature, and also Katapult Ocean's approach to address that. So Katapult Ocean, we're an impact investor. We're based in Oslo, Norway. What does impact investing mean? Essentially, we invest for profit because of impact. So profit because of positive change. So arbitrating around, hey, there are many valuable pieces in society and nature which aren't being valued appropriately. And we try to capitalize on that disconnection when we see the great companies building real value will be rewarded in the long term, and companies destroying social or environmental capital will be worth less. And we're really trying to invest for the long term to extract that positive impact and positive value. Ocean, I mean, this is one of the least invested spaces globally in the venture capital world. It receives about 1% or less than 1% of venture capital funding, and it's most of the planet, it's most of nature. It's responsible for absorbing most of the excess heat since the Industrial Revolution, and about 30% of excess carbon. So why are we not able to appreciate this, and how do we address that structural failure? We all know that the ecosystems are under threat globally. This is some work from the Stockholm Resilience Center that you're probably all quite familiar with, passing these environmental thresholds over time. And what has been buffering these changes? It's been the ocean. This top red line was from 2024. I think 2025, this daily surface temperature reading is even going higher. And what does that mean for ecosystem, for coral reefs, for the ocean's ability to continue to absorb that excess CO2? Essentially, it's not good, and we're seeing a lot of these consequences on the Norwegian coastline, but also globally. And what does that mean for capital at risk? So next 15 years, $8.5 trillion capital at risk from publicly traded companies. So this is market cap value at risk, $8.5 trillion in 15 years, if we do nothing. If we do something, we're taking action. We're limiting that to about $3.3 trillion value lost. So this is the companies, the big companies in the world, our stock markets, our pension pots are invested into. We're looking at huge losses based upon environmental capital destruction. But if we do something, we mitigate that to $5.2 trillion. But notice this is environmental capital. It's an exponential curve downwards, and it happens over the long term. And our financial markets aren't really equipped to focus on the long term. And this is the big disconnect between investing for nature and where most capital is channeled today. And essentially those who can capitalize and think for the long term will be able to capitalize and make outsized returns, capture more of that 5.2 trillion, and more of that upside if they're able to think beyond normal durations for investment. So who can capitalize this 5.2 trillion? Please excuse the rough sketch, and some of this will maybe fall down to scrutiny in terms of the overlaps between the different sectors here I've mentioned. But we have institutional investors, we have pension funds, insurers, we have the debt markets, essentially pots of money where we need to be able to pay obligations within reasonable timelines. So put your money into a private asset, comes out between 4 and 5 years, maybe less. We have philanthropy on the other side, which doesn't have really a return expectation. We have venture capital, private equity, which might be a bit longer term. We have impact investors, that's where we sit. So really thinking about impact orientation on long-term investment, long-term value. We have systemic change enablers, which are again kind of supporting organizations to try and mobilize capital. And we have this high net worth or family office category, which probably is the most interesting area or type of capital to invest in nature, because these are groups which have both an intergenerational interest, because these are families who want to have a survivable planet for their kids and future generations, but they're also interested in capital and making capital go to work. They don't have to pay their pension pots or pay out their insurance, for example. So I've sketched here on this chart a transition wall. So we have existing markets, which are the markets we all know and understand, and profitable business can be built around immediately. And we have new markets, for example, the markets for natural capital. And how do institutions allocate money or capital to new markets where it isn't possible to be profitable? That's a very difficult dilemma, and we need to start taking a longer term approach to build markets. That's where impact investing, systems change enablers, and high net worth / family offices can play a very important role. These groups who can think about long-term capital and intergenerational equity. If we map this onto this kind of $5.2 trillion, we can see quite quickly that those who can think longer term will be able to reap greater rewards. And I think one of the structural factors we need to address in the capital markets is taking this intergenerational approach to investment in equity. Most venture capital funds, for example, are based around a 10-year fund structure. If a natural ecosystem takes 30 years to increase in complexity, for example, and values are extracted over that time, we have a huge problem, right? So how do we think beyond this lifetime return wall? Why are funds based upon 10 years? Maybe it's because people's careers last 30 years. Maybe it's because people's lifetimes last 80 years, 90 years. So we have these structural time markers which have led us to fund structures which don't suit this long-term horizon which we need to invest in order to preserve nature and build natural capital value. This is a little bit of a depressing slide. Essentially, here is the kind of the largest capital pools, trillions of dollars in family offices and in pension funds and insurance, private equity, VC allocations, philanthropy, and then we have ocean. So bear in mind that about $300 billion was spent, or was planned to be spent in 2025 on AI data center capex, which will have huge energy requirements for something we don't even know if we need as a society. And our most vital area of natural capital globally has received piddly $2.3 billion. This is a 2024 figure. It's just not enough. And the ocean's role in 2050, we can sequester 35% of the carbon required to meet our 1.5 degree target just from ocean industrials alone. Our approach, we're investing in markets which do currently exist, so food and water, power, transportation, and circular resources. But we're also very interested in natural capital and building that market. Here are some gaps. You know, we're meeting about 2% of the capital required for decarbonization in maritime, 1% for clean energy, which is minuscule. But for environmental preservation, the capital required, we're only investing about 0.3% of what is required for our targets for 2050. I think I'll wrap there. I'm getting buzzed and called, but thank you very much. Short plug, we're working on this investing systems change approach to private investment to build ecosystems, looking at the interplay between industrial segments, healthy markets, healthy communities, and thriving ecosystems. So oceanreturns.com, please take a look if you'd like to learn more about how we're mobilizing capital. Thank you.
Thank you so much, Ross. Now, actually, I welcome both Ross and Brian to our stage. We are entering our discussion panel. So yeah, Ross, thank you for a very good presentation. I think in the end you mentioned the ecosystem. I think the ecosystem you mentioned is different from the ecosystem with our kelp ecosystem, blue forest ecosystem. But I think both are very important. Both of you are very experienced investors. With Ross, you have 12 years experience as investment managers, and Brian, you have been I've been knowing you for quite a while, from original Oceanomics to now actually Oceanomics were seeking funding at that time, and now the Restorae has been very, very successful from the day one. So I have a question to both of you. In your experience, what factors matter most for a blue carbon project to secure funding from the private sector?
Ooh. You want to take that one first?
I'm going to jump on your regulation point, I think.
Okay. Yeah.
Because if there are different pools of capital, and different pools of capital can take different types of risk. And I think, for example, venture capital, private equity, we need to see certain returns. We need to see markets existing and a very high upside. So investing in a project, for example, isn't going to be for us. But for example, for family offices, for investors looking for yield assets, if there are stable cash flows coming from a project, then that can be very interesting. But how do you guarantee stable yield on blue carbon or environmental capital assets? You really need to have a good structural regulatory regime in place. You need to have visibility on the price of carbon for some duration going out on a long-term project. And I guess I'm concerned that voluntary markets, as soon as you have a huge energy demand somewhere else, for example, I don't know, getting gas turbines for data centers, carbon becomes a cost, and then it's very difficult. You're having two massive forces pulling directly against each other, and the voluntary kind of consumer surplus to justify carbon price won't be enough, and you need to have the regulatory piece in place.
Yep, I couldn't agree more. I think if I were to add one piece is that I think the benefit or the uniqueness of the voluntary markets for carbon or any other credits for that matter is that it's an opportunity to experiment and figure out what are the methodologies that can in the future become part of the compliance universe and scale up with pension funds, with the state and other bigger financial muscular organizations to jump in. I think right now, a lot of the restoration plans that we're working on are either too small for pension funds to come in or just too uncertain. But once you have the regulatory framework in place where you know the credits will be there, you know that there's going to be a stable income stream that's going to come out of it, then suddenly it becomes bankable. And I think that's really where we need to get to, is we need to get these restoration projects out of the experimental universes and get them into fundable projects. And I think that has to happen in two forms. One is that the capital needs to be there. But in order to unlock that capital, we need to also have the regulations be there so that the capital becomes reliable and believable.
So I'll add one more point.
Yes, of course.
I think the kind of the asset class piece and like really maturing that is a really important point. So to move institutional money, you need to be of an institutional size. So how do you create projects or a diverse pool of projects which are large enough to mobilize not just millions of dollars, but hundreds of billion dollars or billions of dollars into a diverse group of projects. And I think we also need to kind of build the volume of projects to get the large capital to be able to move into diversified products. So it's a little bit of a chicken and egg piece, which requires this ecosystem to build and grow and mature, which I think is what we're both working on.
But I think that's where I feel the optimism that I get is precisely because we're starting to see major organizations like the EU, like the Japanese state, like the Norwegian state, actually starting to get their head around the idea of alternative funding mechanisms. So in the Vedtak 789 in Norway, for example, it says very specifically that we're going to be looking into alternative funding. And the report that came out from the Marine Institute also talks about looking into alternative funding beyond just a state paying for restoration. So I think it's going to be a combination of both state as well as an industry to be involved, but industry just needs to have that proper framework to be able to deploy, get past their own internal compliance officers, get past their own accounting departments to ultimately do what is right for the company and for the planet.
Yes, it's really exciting to see that in the near future, the both ecosystem for financing for blue carbon will increasing, and also which could support the further scaling up of blue forest ecosystem, the real life. Yes, thank you so much for attending today's webinar, and we welcome you to keep eye on our website, and there will be a third webinar in our series in the new year. Thank you so much.